welcome back. In this video, we are going to break down the key terms every trader must understand: the spread, the bid and the ask price, lot size, leverage, margin, equity, take profit, stop loss, and other type. If you ever place a trade and didn't fully understand what was happening behind that trade, this video is for you. Let's start with the spread. The spread is the small difference between the buying price and the selling price. It's a hidden fee the broker earns for executing your trade. If you ever open a position and notice your trade starts slightly in negative, that's the spread at work. It's the cost of doing business in the forex market, and that spread comes from the two prices you always see on your chart, which is the bid and the ask price. The bid price is the price at which you can sell a currency, and the ask price is the price at which you can buy. That's why they are pronounced differently, because they represent opposite side of a trade. The broker buy from you at the bid and sell to you at the ask. The difference between both, this, which is the small gap, is the spread we just talked about earlier. Let's move one step deeper to the size of the trade itself, known as the lot size. The lot size simply means how big your trade is. It tells how much of a currency you are buying or selling. A standard lot is equals to 100,000 units. A mini lot is equals to 10,000 units, and a micro loss is equals to 1,000 units. Your lot size determines how much you gain or lose per pips. So the bigger the loss, the bigger the risk. That's why professional traders don't just pick random size. They calculate based on risk per trade, not emotions. But how are you even able to control larger trade size with small amounts? That's where the leverage comes in. Leverage allows you to control a bigger position with a small amount of capital. For example, 1:100 leverage means you can control a $100,000 unit with just a 1,000 deposit in your accounts. It's powerful. But remember, leverage is a double-edged sword. It can multiply your profit, but it can also multiply your losses. Always use it wisely. You can set your leverage when creating a new trading account. I made a video regarding this. Check the video that will pop up next to know how to set up your leverage. The moment you use leverage to open trade, your broker lock a small portion of your capital. That's what we call the margin. The margin is the security deposit. It's the amount your broker holds aside to keep your trade running. It's not a fee. It's just part of your capital being used to maintain your position. If your open trade goes too far against you and your equity drops too low, you will face what is called a margin call, meaning broker might close your trade to protect you from deeper losses. So margin management is critical. It's the foundation of risk control. Equity represents your real-time account value. It's your balance plus or minus your open profit or loss. So if your trade are in profit, your equity increase. If they are in drawdown, your equity loses. That's why professional traders pay more attention to equity, because it shows you true account heads, not just past balance, to understand how your account value move. In order to protect and grow it, you need a take profit auction. Take profit OTP is your automatic exit when the market hits your target. It's lock in your profits without you needing to watch the chart all day. Having a TP keeps your trading plan disciplined. You know exactly where you will get at, and your setup pays out. Setting a TP is not about greed. It's about structure. And just like you plan your profit exit, you must also plan your loss exit. And that's where stop loss comes in. Stop loss, or SL, is your defense line. It automatically closes your trade when the market moves too far against you. Every trader takes losses, but smart trader limits theirs. Your stop loss doesn't mean you expect to lose. It means you respect your capital. It's one of the strongest signs of trading maturity. Now, once you understand where to enter and where to exit, the next question is how to place those trades in first place. And that's what other types are all about. And there are two main ways to enter the market. which are the market execution and the pending order. The market execution means you buy or sell immediately at the current price, and the pending orders, on the other hand, lets you plan your trades in advance. You can set a buy limit, sell limit, buy stop, sell stop, depending on where you expect price to move next. This is how professional traders set traps in market. They don't chase price, they let price comes to their plan, and that's how all these pieces connect. From spread to ask to bid price to lot size, leverage, margin, equity, TPSL, and other type. Each of these play a role in helping you to trade smarter. So this is the full foundation of how the forex markets work behind the scene. If you can understand these 9 elements, you will never look at the trading platform the same way again. You will know what every number means and why every click matters. If this helps you, drop a comment saying forex basics understood and share with someone still trying to figure out the basics. Till next time, trade smart, stay patient, and respect your capital.